Hello, in this video I will be providing information on an important rule that affects us all on a day-to-day basis. We often don't think about it because we just comply. It is the banking rule of 72. It affects us in our dealings with the financial institutions, when we save with them, borrow from them through loans and mortgages, accept credit cards from them that they so easily provide us with. What is this rule? It is an old banking principle. The rule of 72 is a simplified way to determine how long an investment will take to double, given a fixed annual rate of return. I will use a very simple example to illustrate how it works. Assuming an initial investment of £10,000 and the rate of return of 3%. Most of us save in bank accounts, but we'll be very lucky to even get 3%. It's quite exceptional. The question is, how long will the £10,000 take to double to £20,000? What we do is apply the banking rule of 72. We divide 72 by the 3%, divided by 3, and the answer we get is 24 years. So it will take 24 years for our initial investment of £10,000 to become £20,000. How do the banks use this to their own benefit? I will demonstrate it by using various percentages and also the length of years that they take to double. The percentages I'm using are 3%, 6%, and 12%. As we demonstrated earlier, we saw that it took 24 years for our £10,000 initial investment to become £20,000. And it takes another 24 years for it to be £40,000. So in total, at original £10,000 becomes £40,000 48 years later. An interesting thing happens at 6%, when we realize that by applying the banking rule of 72, our £10,000 now doubles every 12 years, as you can see on this slide. So by the year 24, it becomes £40,000. And when we continue on to the 48th year, our original investment of £10,000 is now worth £160,000. However, when we borrow from banks, we usually get charged more. So this affects our repayment, therefore. So let's take 12%, which is quite low when we borrow from them. An initial loan now of £10,000 doubles every 6 years. So when we take out a mortgage, take out a loan from them, and they charge us as such a higher interest rate, we see how much money we're having to repay to them. In this example, at 12%, the original loan or investment doubles every 6 years. So the 10,000 becomes 20,000 in year 6, becomes 40,000 by year 12, and by the 48th year, it's worth £2,560,000. So when we do take out a loan or a mortgage, 24-year mortgage for example, we're paying a lot more than when we put our monies in the bank and save them. So this rule always benefits the banks because they lend at a higher rate but when we save, we get paid at a lower rate. That is how the banking rule of 72 affects us on a day-to-day basis.